Hey everyone, welcome back to our English and economics chat. I'm Michael.
And I'm Michelle. Today we're asking, gold and silver spiked up in price. What's going on?
If you've looked at the markets lately, you've probably seen some shocking numbers. Gold is near $5,000 per ounce, and silver has blasted above $100.
That's right. These are record levels. Gold hit new highs in January 2026, and silver's move has been even more dramatic after already jumping a lot in 2025. So today we'll explain why this is happening using clear English, and we'll highlight useful vocabulary.
Let's start with the big picture. Over the last year, gold has been in a strong bull run, climbing to all-time highs and then pushing even closer to 5,000 in January 2026.
And meanwhile, silver has gone from roughly $30 an ounce in early 2025 to above $70 by the end of the year, and then it broke through $90 and pushed toward $100 in the first weeks of 2026.
So the first key term for today is bull run. A bull run means a strong, sustained rise in prices over time driven by confident or optimistic buyers.
And we're not talking about a small move. Silver's price has more than doubled over 12 months, with gains well over 200%, and in 2026 alone, it has already jumped by a large double-digit percentage.
Let's talk about why investors are so interested in gold and silver now. One word: uncertainty. There's a lot of geopolitical tension, tariff threats, and nervousness about the global economy.
Exactly. When people don't trust traditional assets like certain currencies, government bonds, or even some stock markets, they often look for what we call safe havens. Gold and increasingly silver are classic safe haven assets.
Another important phrase is waning trust in U.S. assets. Some recent reporting says that worries about U.S. debt, politics, and the path of interest rates have pushed investors towards gold.
So imagine you're an investor in a country facing political drama and heavy government debt. You might fear inflation or currency devaluation. Holding gold or silver becomes a way to protect your wealth against those risks.
And that's not just individuals. Central banks around the world have been adding to their gold reserves, giving a stable base of demand that doesn't depend on day-to-day trading.
Vocabulary time: central bank demand. This refers to buying by national monetary authorities. When central banks buy more gold, it sends a signal that they want to diversify away from certain currencies and secure long-term value.
Now, let's connect this to monetary policy. Recently, markets have been expecting the Federal Reserve, the U.S. central bank, to start cutting interest rates later in 2026.
And when interest rates fall, or investors expect them to fall, the real yield on bonds often drops. That makes non-yielding assets like gold more attractive because you're giving up less interest by holding them.
So the phrase to remember is Fed rate cut expectations. These expectations can weaken the dollar and reduce real yields, which typically supports higher gold and silver prices.
Some analysts say ETF inflows, money going into gold and silver exchange-traded funds, are already picking up in anticipation of this easier policy. This shows that investors are trying to front-run or move ahead of the central bank.
So far, this explains gold pretty well, but silver's move has been even more extreme. Why is silver racing ahead?
Several reasons. First, silver has a smaller market than gold, so when big money flows in, the price can move quickly. Second, silver is both a financial asset and an industrial metal, used in solar panels, electronics, and other technologies.
Recent analysis points out that silver has outperformed gold dramatically, with its price rising by well over 200% in 12 months and breaking historic levels near $100.
There's also a supply angle. Silver has been running structural deficits, meaning demand has exceeded mine supply plus recycling in recent years. That tightens the market and makes price spikes more likely.
One key idea is a physical squeeze. Some commentators argue that there has been a physical run on silver, where institutions that previously traded paper contracts are now demanding actual metal, draining inventories in major hubs.
This ties into another technical term, lease rates. In normal times, short-term lease rates, the cost to borrow silver, are low, but in early 2026, those rates have jumped, signaling scarcity.
Let's talk politics, because the title of this show is Politics and Finance. How do political decisions feed into this rally?
Think of three channels: trade, sanctions, and energy. Trade tensions and tariff threats can slow growth, disrupt supply chains, and increase uncertainty. All of this pushes investors towards safe havens.
Some sources also highlight energy disruptions and broader supply chain risks. When energy is expensive or unstable, the cost of mining and refining metals rises, and that can reduce supply, or at least limit how quickly it can grow.
There's also the China factor. China has been a key buyer of both gold and silver, and recent commentary suggests Chinese demand for silver has accelerated, especially because silver is used in clean energy and advanced tech.
So you have this combination: central banks buying gold, China boosting demand, geopolitical anxiety, and expectations of easier U.S. monetary policy. Together, they create a powerful narrative for higher precious metal prices.
For learners, a good phrase to remember is a perfect storm of factors. It means many different forces are hitting at the same time and amplifying each other.
Now, to be fair, not all of this move is purely fundamental. There is also speculation, traders betting on higher prices and sometimes exaggerating moves.
Some analysts in late 2025 pointed out that underneath all the hype, gold and silver are still driven mainly by basic forces: investment demand, central bank buying, and concerns about supply and demand.
But in 2026, we also see words like speculative frenzy associated with silver at or above $100. That suggests many short-term traders are piling in, hoping to profit quickly.
So here's an important pair of words: fundamentals and speculation. Fundamentals are things like supply, demand, interest rates, and macroeconomic conditions. Speculation is trading mainly based on price momentum or stories, not on long-term value.
A healthy market has both, but when speculative activity builds on top of strong fundamentals, prices can overshoot to the upside. That's what some commentators worry about with silver right now.
In simple English, solid reasons started the move, but extra excitement is making it even stronger and more volatile.
Let's imagine we're advising a student who's thinking about investing. What would we say?
First, volatility. When silver jumps from 60 to over 90 in just a few weeks and pushes toward 100, that move can reverse quickly. Prices that rise in a straight line rarely stay there forever.
Second, time horizon. If you're a long-term saver worried about inflation or currency risk, holding some gold or silver can be one strategy, but it should be part of a diversified portfolio.
Third, political risk. Policy decisions like sudden changes to interest rates, capital controls, or trade restrictions can dramatically change the metal markets. That makes it dangerous to treat gold and silver as can't-lose bets.
A useful phrase here is uncharted territory. Analysts say that current price levels are beyond what traditional models predicted, which makes forecasts harder and increases the chance of sharp corrections.
So, in simple English, yes, gold and silver are very strong, but that doesn't mean they only go up.
Before we wrap up, let's quickly review some vocabulary from today's episode.
I'll say the term, and you give a short definition. Ready?
Let's go.
Number 1, bull run.
A period when prices rise strongly over time, often driven by confident investors and positive momentum.
Number 2, safe haven asset.
An asset that investors buy in times of crisis or uncertainty because they believe it will hold its value, like gold and sometimes silver.
Number 3, central bank demand.
Buying by national central banks, often to diversify reserves and reduce dependence on a single currency.
Number 4, Fed rate cut expectations.
The belief that the Federal Reserve will lower interest rates in the future, which usually weakens the dollar and supports higher gold and silver prices.
Number 5, physical squeeze.
A situation where many buyers demand actual metal, not just paper contracts, and available inventories become very tight, pushing prices and borrowing costs higher.
And last, speculative frenzy.
When many traders jump into a market quickly, trying to profit from fast price moves, sometimes pushing prices beyond what fundamentals justify.
So, what's our main message today?
Gold and silver have spiked because of a mix of fear, central bank and investor demand, expectations of lower interest rates, supply constraints, especially in silver, and a layer of speculation on top.
And from an English learning point of view, this topic is a great way to practice vocabulary about economics, finance, and politics, all at the same time.
If you enjoyed this conversation, let us know which topic you'd like us to cover next: cryptocurrencies, housing markets, or maybe inflation and wages.
Thanks for watching and practicing your English with us. See you in the next episode.
Bye for now.